Bitcoin is trying to hold the line, but the warning did not start inside crypto. It started in the AI trade, where chip stocks suddenly stopped looking unstoppable. For months, Wall Street treated artificial intelligence like a blank check. But now, the market is asking a harder question. Who pays for all this growth, and when does the profit actually arrive? This is the calm metrics, and today the message is simple. Bitcoin is not falling alone. It is reacting to a broader risk signal. The first signal came from the semiconductor trade. When chip stocks weaken, the market is not only selling one sector, it is questioning one of the biggest leadership stories of the entire year. AI has been the emotional engine behind risk appetite, from mega-cap tech to speculative assets. And that means weakness in AI can quickly spread into other crowded trades. If the strongest part of the market starts to crack, investors begin checking everything else they own. That is where Bitcoin comes in. Bitcoin is often described as independent, decentralized, and outside the traditional system. But in real market conditions, it still responds to liquidity, ETF demand, and risk appetite. When money is flowing into Bitcoin ETFs, the price has a support engine behind it. But when flows turn negative, that support becomes much weaker. Price is the surface, but liquidity is the message. And right now, the message is not as strong as bulls want it to be. This does not mean Bitcoin is dead, and it does not mean every pullback becomes a crash. It means the market is forcing investors to separate belief from demand. A strong story can hold attention for a while, but only real buying can hold price. If ETF flows stay weak while AI stocks keep losing leadership, Bitcoin could remain vulnerable even if the long-term narrative still sounds powerful. The second pressure point is macro risk. Oil moved back into focus after the latest Iran and Strait of Hormuz headlines reminded traders that geopolitical risk has not disappeared. Higher oil prices can bring inflation fear back into the conversation, and inflation fear can keep pressure on yields, the dollar, and the Federal Reserve path. That matters because Bitcoin and high-growth tech usually perform best when liquidity feels easier, not when the market is preparing for another inflation shock. So the real story is not just Bitcoin versus AI or crypto versus stocks. The real story is whether the entire risk trade still has enough liquidity behind it. AI stocks are where the warning appeared first. Bitcoin is where the warning becomes easier to see, and oil is the reminder that macro risk can return at the worst possible time. This is why investors should not only watch price, but also watch what confirms price. There are 4 signals that matter now. Watch the semiconductor trade to see whether AI leadership stabilizes. Watch Bitcoin ETF flows to see whether real demand returns. Watch oil to see whether inflation risk comes back. And watch yields to see whether the market becomes more defensive. If all 4 signals improve, this pullback may become another reset. But if AI stays weak, ETF outflows continue, and macro risk rises again. Bitcoin may be telling us that the easy part of the risk rally is over. At the Calm Metrics, we do not chase every headline as if it is the whole story. We look for the connection between price, liquidity, psychology, and timing. Right now, the connection is uncomfortable. The market is no longer giving free trust to the AI boom, and Bitcoin is no longer getting the same ETF support that helped fuel the previous move. The question for this US morning is not whether Bitcoin can bounce for a few hours, but whether liquidity is still willing to fund risk.